with the so we'll start the meeting. Good morning. My name is John Von Paris, and I am the chairman of the MDTA Finance and Administration Committee. And excuse me. And we will be conducting today's meeting. Today is Thursday, May 14th, 2026, and I hereby call the meeting of the Finance and Administration Committee to order at 9:02 a.m. In accordance with live streaming laws, this meeting is being conducted via video conference and is being live streamed on the MDTA Finance and Administration Committee webpage. As a reminder, all members of the committee will have their video active during the entirety of the meeting. To minimize background noise during the call, I would ask that everyone on the line please mute your phones. Anyone who is presenting or answering a question, please turn your video and audio on when speaking. When you're done, please turn your video off and put your audio back on mute. There are no members of the public, no elected officials, and no media who have pre-registered to comment at today's meeting. This time we will move on to agenda item number 1, the approval of the April 9th, 2026 open session meeting minutes. Is there a motion? Approve the minutes?
Member Ardinger also approve, or so move.
I'll second, Member Carroll.
Thank you. We have a motion and a second. All those in favor?
Aye.
Opposed? Motion carries. Thank you, members. Item number 2 is an approval item of the April 9, 2026 closed session meeting minutes. Is there a motion?
So moved, Member Rosen.
Thank you, Member Rosen. Is there a second?
Second, Member Carroll.
All those in favor?
Aye.
Aye.
Opposed? Motion carries. We move on to, thank you for that. We move on to item number 3, approval item contract number MT 00211-593, facility-wide hazmat disposal and abatement services. And Paul Truntish is here to present. Paul, are you there?
Yes, I am, sir. Thank you so much, and good morning. My name is Paul Truntich. I am the Director of the Office of Environment, Safety, and Risk Management at the Maryland Transportation Authority, and I am here to seek the committee's approval to award contract MT 00211-593, facility-wide hazmat disposal and abatement services to Calani Environmental Solutions. This contract will provide periodic decontamination, abatement, and/or disposal of biological, medical, and infectious wastes, hazardous wastes, hazardous materials, unidentified wastes, and regulated wastes for the Maryland Transportation Authority's facilities. And with that, I'm open to any questions the committee members may have.
Thank you, Paul. Are there any questions? Member Oettinger?
I see there's quite a difference in the bids that were received. Is this entity, was there an estimate of what they thought the cost should come in at? And is this an entity that we've dealt with before?
The estimate that we came up with for based on historical data for the 5 years was $2 million. So the number one low bidder was within that price range. And the company has held this contract currently. They are not the incumbent, but they have held this in the past. And we have worked with this entity through other contract vehicles. So we're confident that they can do the work and for the prices they have provided for us.
Okay, thank you.
Good question. Any other questions? Okay. Is there a motion to advance this item to the full board for approval?
Member Ardinger also move.
Thank you, Member Oettinger. Is there a second?
Second, Member Rosen.
Thank you, Member Rosen. Is there any further discussion? Okay. All those in favor?
Aye.
Aye.
Opposed? Motion carries. Paul, thank you for your time.
Thank you all very much.
Thank you, and everything you do. Thank you. We will move on to item number 4. And this is an approval item, contract number CC 00211-584, Road Rake Model 200T Roadway Litter Collector. And Jim Lucas will be, we'll hear from him this morning. Hey, Jim, how are you?
Morning, members. Doing fine, thank you. I'm here to present for the approval of the Road Rake Litter Collector. This is a large piece. It's a piece of towable equipment that we use on our shoulders for picking up litters, large type of litter, such as retreads, tires, mufflers, animal carcasses. And it primarily keeps our staff off the roadway. They would have to do this manually. They'd have to get out of the trucks in order to pick up this, this debris and put it into the back of either a dump truck or a pickup truck. These are mounted on dump trucks using existing hydraulics, and they're efficient, they're fast, and again, it keeps our staff safe.
Thank you. Are there any comments from any board members? Okay. I think, it's a sole source here, right?
Yes,
Is that right? So
that's correct.
can you talk about that a little bit in terms of the challenges that you may have faced on that with trying to get some competitive pricing?
Well, currently we have 3 units that are already in service and maintenance, 1 FMT and ICC. And in research that we've done in the past and recently when this went up to procurement, There was only one piece of equipment that it's a different type. It mounts to the front of the truck called a gator getter. You use it at highway speeds, and it does pick up some debris, but it's got a smaller hopper, and there's still manual intervention. So when staff gets back to the yard, they still need to lift the hopper up, and they have to manually, physically, they got to remove anything that they picked up, whether it's wood. I mean, so there's wood, there's contaminants, like I said, animal carcasses. So it's a completely different piece of equipment. This is the only piece that I know of that's used nationally, actually internationally, that's beneficial for what our needs are out in maintenance.
Okay, well, thank you for that explanation. You're close to it, and you know what's going on, and you're the fleet administrator, right? So,
Yes, sir.
good work. We're just asking as part of our responsibilities for that. So, thank you for the explanation. Appreciate it. Anyone else have any comments? Okay. All right. Motion. Is there a motion?
Member Arndinger also move.
Second,
Okay.
Member Carroll.
Okay, thank you. We have a motion and a second. Any further discussion? All those in favor?
Aye.
Opposed? Motion carries. Thank you. And thank you, Mr. Lucas. Appreciate
Thank
your
you.
comments.
Thank you, members.
Have a good day.
You too.
We'll move on to the next agenda item, number 6, Investment Committee Report, quarterly update on the investment of MDTA's funds. And Clayton Bwig is here to once again give us an update. So good morning, sir.
Good morning. Thank you for your time this morning. We're pleased to review the financial market, investment strategy, portfolio activity, and performance as these relate to the financial assets of the agency for the quarter ending March 2026, as well as to confirm adherence to the governing statutes, indenture, investment policy, and guidelines. Consistent with our ongoing process here, we are to ask at the end of the presentation for your approval, maintain the investment strategy and process. You may have noticed there have been a few modifications to the report, but the essence of the information we're providing remains relevant and consistent. So that being said, we're pleased to once again report that the financial assets of the agency remain invested according to the mandates you've prescribed and approved, and there have been no violations during the period being reviewed today. Additionally, during the quarter, the portfolios remain diversified by sector and issuer. As we see on slide 3, inflation has ticked higher the past couple of quarters, exceeding 3% with the most recent print, according to the Fed's preferred measure of inflation, that being core PCE. The Fed has noted that the economy remains expansionary with the spending and investment brisk. This is on top of stable unemployment in the economy. Other measures of inflation, such as PPI and CPI, have printed much higher than anticipated just this week. Inflation does remain the topic of the moment, and comments to the effect that this measure has been well above target for 5 years. Progress is stalled, with inflation getting worse, are being shared by members of the Fed. Slide 4's chart shows yields somewhat higher during the quarter, also reflected in performance a bit later in the presentation, and still at what are elevated levels when compared to pandemic rates. But this holds for longer periods as well. While lower than their highs in late 2022 and 2023 by approximately 1.5%, the 2-year yields remain at a historically higher level, similar to where they were from 2004 to 2007, which is not shown on the chart. This remains true also for 10-year government bond yields, with a more modest drop of roughly 75 basis points from their peak in 2023. Moving on to slide 5, we see the sector allocation for breakdown of the assets and notice the sizable exposure to MLGIP. This given the continuing yield advantage over comparable security fund types. This yield advantage has declined materially over the past year or so, and if this continues, we would expect a smaller allocation to MLGIP as a percentage, of course, to the area as we rotate out of this into Treasury or agency securities. Indeed, recent levels on MLGIP have seen yields only a couple of basis points above Treasuries, but about 17 basis points above money market fund levels. Looking at the slide, you'll also see the exposure to the municipal sector reflected at 20%. And this is very close to the policy limit, but it is actually slightly less than the policy limit. So the portfolio is indeed in compliance. Slide 6 and 7 show the maturity breakdown. 6 illustrates the breakdown for the entirety and 7 for just the long-term reserve accounts. Moving on to slide 8, we begin the compliance section of the report, broken out to 3 pages this quarter. The accounts remain true to the policy with respect to maturity, sector, and security level constraints. At the bottom of slide 10, just above the grand total, I'll refer you to the subtotal for municipals at 19.7%. As you can see right next to that, the policy limit's 20%. We referred to earlier. This percentage or ratio is a function of 2 things. The number in the numerator or dollars invested in municipals, and the number in the denominator or the total financial assets of the agency. As you undoubtedly recall, the agency has a substantial capital spending program, and as these drawdowns occur, the denominator gets smaller and drives up the percentage of a sector's weight. If you notice a quote unquote violation in the next month, months, or quarter, it's likely caused by this depletion of total financial assets, capital spending as the driver, not a gross violation of the mandate resulting from negligence or ignorance on our part. And this is because pursuant to the governing documents, compliance is measured or calculated on an at time of purchase basis. If the agency's planned financing of $600 million requires more time to complete, while balances continue to decline as a function of normal business activities, i.e. bond service, capital spending, or other day-to-day cash needs, the policy limit may appear to be breached. As we can see, the total portfolio measured $738 million at the end of March. Last September, a bit more than 6 months ago, the total portfolio measured just shy of $1 billion. Please remember also that the investments in the municipal sector only pertain to the long-term reserves, that being the general and the M&O accounts. These investments are made opportunistically when the team has the chance to earn return in excess of a given benchmark security, and this has to date served the agency quite well. Securities in this sector often have even better ratings than the index and are being purchased at attractive spreads, or said otherwise, I guess, discounts. These opportunistic positions have rewarded the portfolios, as we will see near the end of the presentation. Slide 11 illustrates the allocation of trades by broker-dealer over the past year ending March 2026, as well as the year prior ending March 2025. As we have noted in prior meetings, these trade allocations do tend to shift over time depending upon the MDTA preference for securities and competitiveness. Notable also is the large allocation of trades to Janney, but given your approval of their termination after the teams move to Huntington, this will obviously decline fairly soon to 0. Moving on to slide 12, we highlight compliance as it relates to another aspect of managing the portfolios that related to duration. We aim to be very tight to the index, so you will observe that for the current period, both long-term portfolios were no more than 102% of the index. These are passive portfolios, as it relates to interest rates and yield curve positioning. So we will always target plus or minus 3% of the index, although the latitude allows us to go to plus or minus 10%. As a reminder, the general account is permitted to invest out to 5 years, and the M&O account is permitted to invest out to 15 years. So it is critical to keep the relative durations, those numbers circled in red at the top, close to the index. A bit more about strategy as it relates to the portfolios is encapsulated on slide 13. This shows what we define and target as attractive spreads relative to benchmark securities such as treasuries and agencies. An important part of the daily discipline and portfolio management is to abide by these targets. Unless we see an opportunity offering at least the levels indicated on the slide here, we're not interested. And many times, in fact, more often than not, when we do make a purchase, we're able to take positions for the portfolios well in excess of these targets, as is exhibited on the final slide 14. There are a few important points on slide 14 that should be made as it relates to total return performance. First is that over time, we've stressed the importance of taking a long-term view of the returns and portfolio investments. So we've added a 36-month annualized return circled in red there, deleting the 6-month return. Going forward, this will bear forth the notion of earning over a period of time today's prevailing yields, the absolute returns, and also the value add or relative returns for the long-term reserve accounts, namely general and M&O. That excess return on the 36-month period is staggering and probably should not be expected going forward. Second, as referred to earlier, we can see in these same 36-month returns the value add of the opportunistic allocation. As I just mentioned, both in the table circled in red and in the bar chart at the bottom right for the period covering 36 months. Third, we have added a table at the bottom left showing yields for the prior month and the month ending March 31st. Note that the change for the agency index of 40 basis points is almost the same as the change for the strips index of 38 basis points. We see the impact of the longer duration strip index and M&O account for that same period return of 1 month in the bar chart. Now, over time, we do expect the longer duration and maturity to outperform, but as we have cautioned in the past, there will undoubtedly be periods of volatility in rates and thus returns. With that, if there are no questions, the investment committee asks this finance and administration committee to concur and to recommend moving to the full board for a continuation of the investment strategy.
Okay. Thank you, Clayton. Very thorough presentation. I guess on the overall, from a high level, everything is looking good. Would you agree with that?
Yeah. Yes.
So you're pretty much recommending that we stay the course.
Yes, please.
Okay. Are there any Member Carroll? Member Carroll has a question.
Thanks, Member Von Pierce. Clayton, thank you for your presentation. Just a couple of thoughts / questions, or a question rather. Seems like, is it safe to confirm rather that the strategies stress tested against potential market disruptions or the volatility that exists right now, so that we have a certain degree of confidence that this strategy will endure for the next 12 to 24 months or so?
Yeah, and maybe I can refer you back to slide 4 as well. The biggest exposure beta that we have is generally to interest rates.
Right.
And we saw back in 18, 19, and then again in 2021 how rates fell precipitously and then went back up to well over 5% there for a while. Our biggest risk on a mark-to-market basis was during that 21-22 period when rates backed up, 400 to 500 basis points. And so we did experience some mark-to-market losses. The numbers, as you may recall, were not very pleasing to the eye, but we weren't trading the portfolio. We're long-term holders, and the strategy has endured, and we have shown good returns as a result. And that's another reason for showing this 36-month return. We do want to bring you back to this notion or fact that we're long-term focused, and we're going to stay the course with your permission and approval, and hope to bear fruit and demonstrate that over time. As we continue to move forward, we'll consider adding longer term measures of performance, and hope that's okay with your board. Does that answer your question?
I think it does. The reference to slide 4 was helpful. Thank you.
Okay.
Are there any other questions? Okay, I don't see any. The investment committee is supportive of this, right?
Yes, sir. Yes.
Okay, so, all right, well, this point is there a motion to advance this item to the full board for approval? And basically what we're doing here is staying the course. Is there a motion?
So move, Member Carroll.
Thank you, Member Carroll. Is there a second?
Second, Member Rosen.
Thank you, Member Rosen. Any further discussion? All those in favor?
Aye.
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 Opposed? Motion carries. Thank you very much, Clayton.
Thank you.
Okay. We will move on to agenda item number 6. Jeffrey Brown is here to discuss the third quarter budget comparison, review of actual versus projected spending for the fiscal year 2026 operating budget.
Good morning, members.
Good morning, Jeffrey.
Good morning. For the record, my name is Jeffrey Brown, Budget Director for the MDTA, and I'm here to provide an update on third quarter performance budget versus actual for fiscal 2026. As of March 31st, we had spent 66% of the budget compared to a target of 75%. All object codes were at or below spending levels, or budgeted spending levels, except for object 13. The drivers of our performance are the seasonality of expenses, the timing and receipt of invoices, and cost pressures in the IT and insurance markets impacted third quarter performance. Moving on into the detail, object 1, salaries and wages, were at budgeted spending levels with a 71% spend rate. Communications, object 3, is below budget with a 27% spend rate. This is driven by the state radio invoice, which we have not received yet, but will be. And this, once paid, this will bring us back close to budget. Travel, object 4, is below budget with a 40% spend rate. Seasonality drives this underspend, as we usually have heavier spending in the third and fourth quarters, and at this point expect to be close to budget. Fuel and utilities is on budget with a 68% spend rate. Drivers are motor vehicle and operations maintenance, which is below budget with a 58% spend rate. Moving on to detail that's driving that performance is vehicle, gas, and oil, which is below budget with a 30% spend rate. I will note, though, given current economic conditions, especially around gas and oil, I would expect this to start creeping up towards budget. Vehicle maintenance repair is below budget with a 53% spend rate. This is activity that does not come in smoothly, but at this point, we do expect to be on budget. Purchase other land vehicles is below budget with a 41% spend rate. It's dependent on when we receive orders, and we have orders in place, so we expect to be close to budget. Gas and oil and other land vehicles is also below budget with 52% spend rate, but as mentioned before, I would expect this to start creeping upwards. Large vehicle maintenance and repair is above budget with an 84% spend rate. Again, this is an activity that is lumpy, as when it comes in at this point, we expect to be close to budget. Contractual services, Object 8, is below budget with a 56% spend rate. This is driven by advertising, which is below budget with a 20% spend rate. However, we do have active promotions in the fourth quarter, and we expect to be very close to budget. Engineers are below budget with a 44% spend rate. Typically, heavier activity does occur in the third and fourth quarters. However, weather, meaning it's been much cooler and stormy, has impacted this. So there is the potential for savings in this area. Equipment repairs and maintenance is above budget with a 91% spend. This is driven by one-time rubric charges, which is our IT backup services. We do expect this to be close to budget. Building repairs and maintenance is below budget with a 43% spend rate. Again, heavy activity in the third and fourth quarters, plus weather has impacted this. Janitorial services is below budget with a 53% spend rate, while education and training is below budget with a 46% rate. Medical care is below budget with a 38% spend rate. There is a reduced need for pre-hiring physicals due to the hiring freeze, which is driving the underspend. Management studies is below budget with a 36% spend rate due to the timing of activity. Again, at this point, we expect to be close to budget. Security services below budget with a 51% spend rate. We do expect to have potential savings here as a lot of the funding is coming through due to a grant. IT services 841 through Object 869 is above budget with 100% spend rate. The details are central process services is below budget at 46% spend rate, while telecom is at a 36% spend rate. The real driver is application software maintenance, which is over budget at 262% spend. As was mentioned, I think in our last meeting, internal discussions are underway about whether these expenses are eligible to be capitalized. They were budgeted as if they were to be capitalized. The driver of this is we have to break out some of the detailed expenses and review them for the ability to capitalize them, and that is underway. System software maintenance is above budget with 188% spend rate. This is due to the increase in charges from TSO that they're passing along to us, consistent with other MDOT modes. Outside service computers is above budget with an 82% spend rate. Again, this is timing for activity around OpenGov, which is our budgeting software, and Salesforce, which is human resources software. We do expect this to be closer on budget. EasyPass service costs are slightly below budget with a 61% spend rate, while other contractual services are below budget with a 43% spend, which is driven by Maryland State Police overhead charges, which are below budget. Supplies and materials are below budget with a 53% spend rate. It's driven by roadway maintenance, which is at 41%, again, driven by more activity being in the third, fourth quarters and the weather. Salt is above budget with a 65% spend rate due to the winter storms we experienced this year. There is a potential risk as we are expecting additional costs to come through, so we have to monitor this. Uniforms is very close to budget with a 62% spend rate, while ammunition is well below budget with a 28% spend rate. This is driven by when the orders are actually received, while transponders are below budget with a 55% spend rate. Object 10, replacement equipment, is close to budget with a 64% spend rate. This is driven by microcomputers, which is above budget with an 82% spend, while other replacement equipment is below budget with a 36% spend. This depends on when the orders are received. We expect this line to come close to budget. Object 11, additional equipment, is below budget with 44% spend. Again, it's the timing of orders, and at this point, we do expect to be close to budget. Fixed costs are above budget with 26% spend rate. Insurance is Object 1302 is below budget with a 0% spend. The invoice from TSO has not been received as of yet. However, we do expect this to have potential savings when it does come through, while the insurance at Object 1309 is above budget at 106%. This is due to the higher premium associated with market rates, plus the increase in the insurance policy limit. While bad debt is above budget, about 7,000+%, as mentioned before, this is due to the damage expense that occurred to the Bay Bridge in 2016. That concludes my presentation. I'll be happy to take any questions at this time.
Thank you, Jeff. You're so thorough and you're so knowledgeable of the budget and many other things. Great job with that.
Thank you.
Are there any questions?
Yeah, I just have one question. On the IT expenses, is there anything we can do to control for that, to get that back in line? Maybe not in this fiscal year, but going forward, or are
Well,
we out of our
yeah,
hands?
some of these, a lot of it that's driven the big one. Well, there were two big ones really. One was the TSO, which, that was totally unexpected. We now expect it, so we will budget accordingly. So it shouldn't be a surprise. The second is the body worn cameras. I think, I don't want to speak too much in detail. Chantel can probably provide more detail, but, that was expected to be capitalized. I do expect many of those expenses will be capitalized. The hang up was it was all lumped together. We need to break it out because not all pieces of that body worn camera systems should be capital, like warranty expense and things like that. As long as we can break that out, which I think we're in the process of doing, we should be able to capitalize some of that. So I think those were the two big surprises. Most of the others, I think, are timing, which again, it's just, when it hits early in the year, it looks like you're overspending, but you don't have any more invoices, so you wind up being close to budget.
Thank you.
Okay. Well, Jeff, thanks again. And we'll move on to the next item on the agenda. Item number 7, update third quarter budget comparison review of actual versus projected spending for the fiscal year 2026 capital budget. Jennifer Stump is here. Hi, Jennifer. Again, you are all have this have a lot of knowledge and expertise here, and you're always able to field any questions. So you're up. Thank you.
Well, thank you. Good morning. For the record, I'm Jennifer Stump, the Acting Capital Program Manager. Today, I'm presenting the third quarter review of the fiscal year 2026 capital budget versus the actual spending as was outlined in the fiscal year 26 to 31 draft CTP. This information will also be presented to the full board on May 28th. As of March 31st, 44.5% of the fiscal year 26 $1.1 billion budget was spent as compared to the targeted spending level of 75%. Actual spending through the third quarter was $512.9 million. 28 of the 102 projects budgeted in fiscal year 26 were within the acceptable spending limits of 50 to 100%, which is plus or minus a 25% of that 75% target. That's determined to be reasonable due to normal lags in invoicing, which is generally 2 months. The Key Bridge rebuild was at a 36.2 spend rate, while the remaining projects in the CTP were at a cumulative spend rate of 56.5%. And attachment A details 10 projects that were budgeted over $10 million for fiscal year 2026. The actual spending through the third quarter on those 10 projects was $412 million. That does conclude the quarterly update, and please let me know if there's questions. Member Von Parrish, you're still muted, sir.
Sorry about that. It's my first day on the job. Sorry. Are there any questions? Okay, I don't see any. So thank you very much. And you're up for the next, I guess, item number 8 too, right?
Yes, sir.
So we'll just go right into this CTP process and additions presentation. That'd be great. Thank you.
Yes, thank you. Again, for the record, I'm Jennifer Stump, the Acting Capital Program Manager. Today, I'm presenting the Consolidated Transportation Program process and additions to the capital program. This information was presented to the Capital Committee on May 7th and will also be presented to the full board on May 28th. Each year, the Maryland Transportation Authority releases the CTP, which represents their ongoing and new capital projects for a six-year rolling period. After approval by the board, the draft CTP is presented to local elected officials and citizens throughout Maryland for review and comment. It is then revised and presented as the final CTP and presented to the board for approval to be part of the governor's budget to the Maryland General Assembly in January. The CTP is separated into 3 parts: the construction program major projects, development and evaluation program major projects, and system preservation minor projects. Major capital projects are listed individually, and minor projects are grouped and shown by category of work. The construction program major projects and system preservation minor projects programs include ongoing projects and those scheduled to begin construction within the 6-year period. The D&E program contains those major projects which are being prepared for possible future addition to the construction program. Projects are moved from the D&E program to the construction program as funds and resources become available based on the merits of the projects. For project selection, MDTA's capital projects originate from a variety of sources. Long-range capital needs includes planned rehabilitation or replacement projects based on life cycle. The expected useful life of a component does not provide an exact rehabilitation or replacement date, but gives an idea of when MDTA should begin planning and budgeting to address it. Inspection findings used in tandem with life cycle estimates to confirm rehabilitation or replacement is necessary as scheduled or to expedite a project if it's needed ahead of schedule. Regulatory compliance includes projects for EPA mandated stormwater management, increased capacity needs based on traffic forecast recommendations, and local priority letters and legislative requests, which are established each year as Maryland counties and Baltimore City are asked to submit a list of priorities for the state transportation system. Once identified, projects are prioritized based on customer needs for safety and security or increased capacity through improvements or system preservation. Funding availability to budget for identified projects is based on the MDTA 6-year financial forecast, which considers estimates of traffic and revenue, the operating and capital budgets, debt service payments, and the potential need for future bond sales and toll increases and compliance with financial standards. The fiscal year 2027 to 2032 draft CTP to be presented for approval at a future meeting includes 11 new projects, which are detailed in attachment A. We have the dispatch console replacement, which is a multi-area project, resurfacing ICC asphalt pavement, which is inter-county connector project, deck replacement and miscellaneous structural repairs of Bridge BCW 602021 Moravia Road over US 40, which is a Fort McHenry tunnel project. Retrofitting access openings for FMT box girder bridges is a Fort McHenry tunnel project. Rehabilitate and reline sump pump drainage at FMT is a Fort McHenry tunnel project. Rehabilitate and reline sump pump drainage at FMT is a Fort McHenry tunnel project. The Bay Bridge replacement, which is a William Preston Lane Memorial Bay Bridge project. Maryland iStar, which is a multi-area project. Network hardware replacement is a multi-area project. The DINAC maintenance contract, which is a multi-area project. Maximo MAS 9 implementation, which is a multi-area project. And a 10-year equipment budget from fiscal year 2028 through 2037, which is a multi-area project. I do realize I just read those backwards. I apologize. But that does conclude this presentation. Please let me know if there's any questions.
No problem on reading them backwards. I did that too, so that's fine. Don't worry about it. Good presentation. Lot there. It's good to know what's going on in a summary like that. So thank you. Are there any questions from any members? I don't see any. So Jennifer, thanks again.
Thank you.
Good job. Thank you. We will move on to agenda item number 9, update quarterly update on traffic and revenue from Walter Long. Okay,
Hey,
there
good
we
morning.
go. Morning, how are you?
Good. My name is Walter Lawn. I'm the Acting Director of Revenue at the MDTA, and I'm here today to provide an update to the Finance and Administration Committee with a quarterly and year-to-date update regarding traffic and toll revenue trends compared to the previous year and the forecast. So we've got our takeaways up top. It's the total collected revenue was below forecast by $9 million for the period ending March 31st, 2026. And included in this, Easy Pass was above forecast by 1.3 million. So the reason why we look not so great at the end of this quarter is that the video toll and civil penalty fee payments totaling $20.1 million were received from the Central Collection Unit in March of 2026, but did not post to accounts due to a system update at CCU. So taking this timing difference into account, actual revenue would have been 11.2 million over forecast. You go down to page 2, the table at the top there is showing the fiscal 26 actuals compared to 25, and also the forecast versus the actuals for this year. So in the table above, for the period ending March 31st, 2026, year-to-date system-wide transactions totaled 116.4 million, and corresponding toll and administrative revenue totaled 571.2 million. This represents an increase of 0.6 million transactions, or 0.6% compared to the same period last year. Year-to-date revenue decreased by 1.9 million, or 0.3% compared to the same period. The increase in transactions was attributed primarily to the completion of the I-95 express toll lanes, the northbound extension, and that was just for the first and second quarter of the year. It was a catch-up in processing delayed transactions by New York as they transitioned their back office. They sent us transactions late, and they got caught up in July. And the increase in transactions was slightly offset by the delay in processing the CCU video toll payments during March 2026. The delay in processing the CCU video and the civil penalty fee payments also contributed to the decrease in revenue compared to the prior year. For the period ending March 31st, 2026, actual revenue was below forecast by 9 million. EasyPass and pay-by-plate combined revenue were above forecast by 1.4 million and 0.3 million respectively. Video toll and administrative revenues were below forecast by 10.7 million. And again, the underperformance is primarily attributed to that delay in processing of the CCU video toll and civil penalty fee payments. You scroll down to page 3, attachment A. It's kind of showing a table here, breaking out EasyPass, showing the 1.4 million over forecast, and then the video, administrative, and pay-by-plate, which were under by 10.4 million, and overall under by 9 million. In attachment B, right below, it kind of goes from that point of being under 9 million, and we're adjusting it for this timing difference, which is the CCU money, which we did collect, but just had not posted to accounts yet. It's broken down by video and civil penalty fee. So 4.6 million in video, about 15.5 in civil penalty fees. So once adjusted for that, we would have been sitting at 11.2 million over forecast. You go down to attachment C on page 4. This is then taking the adjusted revenue less the forecasted revenue, the starting point of 11.2 million over forecast, and breaking it into categories. So again, it's the 1.4 million for EasyPass, 300,000 for pay-by-plate, under 1.2 million for video toll, and over 10.6 million for administrative toll revenue. And over to the left, you'll see kind of a breakdown. It's driven by the civil penalty fee revenue. It's 9.8 million over forecast. That's all I got there. I guess I'll add in about the EasyPass overage of 1.4 million. That's primarily driven by the Fort McHenry tunnel, where we see the 2-axle traffic there is about 4% over forecast. That's it. So I think that's all I got. If there's any questions. Member Rosen.
Thank you. Thanks for the update. Just so for the ETL 995, I guess it looks like for the dollars we're a little less. I don't know if that's related to some of the timing difference. Since that's a pretty new facility, or the expansion is a new facility. How are we really doing relative to our expectation, not just to what was in the forecast, but when we originally conceived the project?
Compared to the forecast, I don't have the original forecast that was created when the planning was done for the ETLs. We can pull that and provide it to you afterwards. But just compared to the forecast this year, revenue is about 38%. This would be for like EasyPass and video toll combined, so about 38% higher than last year. What we have to take into account, there were a couple things, like even though we see that EasyPass revenue is above forecast by 1.4 million, that is despite like the large snowstorm we had in the end of January, where the ETL was closed down for 2 days while they did snow plowing, and we saw a significant reduction in EasyPass revenue for all facilities during that period after the snowstorm, which we approximate to around $4 million of reduction compared to what we would see normally, what we would expect to see during that time period. So that's kind of affecting it too, and making it kind of lowering our performance versus the current forecast. Plus, on top of that, the video toll transaction is not being processed as they're counted once the payments post.
Sure. I appreciate that. There's definitely a lot of factors in there. Yeah, I think it'd be just good to understand more generally, is this, it exists, it's there, it's not going away, but is it meeting our expectations? Right. And every time I drive by it seems to be pretty popular, but hopefully that's, it's meeting the market and our customers as well.
Yep.
Any other questions? Okay. Walter, thank you very much. Member Carol. Didn't see that little hand there on the top of the screen. So,
thank you, Member Monteros. Walt, thank you for the walkthrough. Perhaps for a future discussion, not to put you on the spot today, but I'm curious as to whether there are any emerging trends that we need to be aware of that could materially impact our financial forecast for future and for future tolling, along the lines of like maybe where Member Rosen was going. Are we seeing anything that would be materially different from our initial projections with the ETL as an example, that we might consider looking at or preparing for future forecasting?
Yep. Yeah, we can certainly put that together. And for instance, ETL is under forecast for the year by 2.6%, by $430,000 total. And that's including the kind of going through that snowstorm, which saw traffic significantly reduced. So I would think it would be closer to even had that not occurred. But yeah, but we can do a little more analysis on that. And again, it's the biggest overperformers we're seeing for Easy Pass, which is the majority of our revenue, is the Fort McHenry Tunnel. BHT is kind of steady right around forecast. JFK is about 1% under forecast or $1 million under. And then all the other facilities are kind of right on point. So okay. Nothing that really stands out as problematic.
Thank you.
Yep.
Great question, Member Carroll. Any other comments or questions? Okay. Walter, thanks again. Appreciate it.
All right. Have a good day.
Yeah. We have now reached the closed session portion of the agenda. This closed session is scheduled for the Finance and Administration Committee members and designated staff. For those persons who are in the meeting or on the live stream, as soon as we have completed the closed session, we will come back to this meeting to ratify any actions that might be taken in closed session and to continue with the remainder of the agenda in open session. We appreciate your patience. Per the Maryland Open Meetings Act, the MDTA board will meet in closed session under the General Provisions Article Section 3-305B14 before a contract is awarded or bids are opened, discuss a matter directly related to a negotiating strategy or the contents of a bid or proposal. If public discussion or disclosure would adversely impact the ability of the public body to participate in the competitive bidding or proposal process. Members, is there a motion to go into closed session?
Member Ardinger also move.
Thank you, Member Ardinger. Is there a second?
Second, Member Rosen.
Thank you, Member Rosen. The time is 9:53 a.m. and we will move into closed session. Okay. Let's see here. Okay, we are back in the open session, and there was nothing, no actions taken in closed session that require ratification. So we will now seek a motion to adjourn. Is there a motion?
So move, Member Rosen.
Thank you, Member Rosen.
Second, Member Carroll.
Thank you, Member Carroll. We stand adjourned. It's 10:51 a.m. Thank you.
Bye, everybody.